On June 12th, Wall Street history will change forever. SpaceX is officially going public in the largest, most anticipated initial public offering humanity has ever seen. Elon Musk is looking to raise a staggering $75 million in cold hard cash, valuing his empire at roughly 1.77 trillion US dollars. The shares are officially locked in at $135 each, and they will trade on the Nasdaq under the ticker symbol SPCX. But behind the massive hype, a brutal battle is breaking out between retail investors and Wall Street institutional firms. Is buying this stock on day one your ticket to generational wealth, or are you being set up to hold a very expensive bag? Today, we are breaking down the newly filed SEC S1 prospectus to give you the truth. Let's look at the numbers. Let's start with the bull case, because the numbers here are genuinely mind blowing. When you buy SpaceX stock, you aren't just investing in a company that launches rockets. You are buying into a global ironclad monopoly. According to the official S1 filing, the real crown jewel of this business is Starlink. Last year alone, SpaceX's satellite internet division pulled in over $11 billion, accounting for a massive 61% of the company's entire revenue stream. Unlike the rocket launch business, which requires massive hardware costs, satellite internet is highly scalable and printing serious profit. But here is the secret weapon that is driving this trillion-dollar valuation: space-based AI infrastructure. The prospectus reveals that SpaceX is actively building orbital data centers. These zero-gravity data centers are designed to run complex computing clusters cooled naturally by the freezing temperatures of space and hooked directly into Elon Musk's XAI ecosystem. This isn't just an aerospace stock anymore. It's a massive AI infrastructure play. Because of this, major analysts are predicting that overwhelming demand from institutional funds could cause the stock to skyrocket immediately upon launch, with some targeting a $5 trillion valuation by the end of the decade. If you can get your hands on shares, then upside looks astronomical. But don't open your brokerage account just yet, because the downside risk is terrifying. Now, let's look at the cold hard truth that the mainstream media is completely ignoring. SpaceX is one of the most aggressively overpriced companies to ever hit the public market. At the initial offering price of $135 a share, SpaceX is trading at a valuation of 94 times its annual revenue. To put that into perspective, Nvidia, which has been absolutely dominating the AI gold rush, trades at roughly 21 times its revenue. SpaceX is literally valued 4 times higher relative to its sales than the hottest tech company on earth. This is an extreme premium. And while Starlink is highly profitable, the core rocket engineering side of the house is a historic gas furnace. Building the Starship fleet, clearing federal regulatory hurdles, and maintaining deep space infrastructure caused SpaceX to post a massive $4.9 billion net loss last year alone. Public markets do not tolerate multi-billion-dollar losses the way private venture capitalists do. Historically, when a massive, hyped up company goes public, retail investors who buy at the opening bell get absolutely decimated. Institutional insider buy in cheap, the stock pumps on public excitement, the insiders takes their profit, and everyday investors are left holding the bag as the price plummets. If you buy blindly on June 12th, you risk walking straight into a meat grinder. However, this IPO has a very strange twist that changes the math for everyday investors. In an unprecedented move, SpaceX is reportedly allocating up to 30% of the entire offering directly to retail investors. This means you do not have to wait for the stock to start trading on the open exchange. Major brokerages like Fidelity and Robinhood are allowing users to request a pre-IPO allocation. If you apply through your broker and get selected, you get to buy your shares at the exact fixed institutional price of $135 before the public market ever touches it. Getting shares at $135 completely changes your risk profile. Even if the stock experiences extreme volatility later on, buying in at the baseline price gives you an immediate safety cushion that open market buyers simply won't have. So, what is the ultimate verdict? Do not buy the hype on day one if you miss the pre allocation. If you can successfully secure shares through your broker at the fixed $135 initial price, it is an incredible, once in a generation speculative asset worth holding for the long term. But if you miss the allocation and you see the stock pump to $200 or $250 when the opening bell rings on June 12th, do not let FOMO win. Sit on your hands and wait. The initial hype will fade, early investors will take profits, and the price will experience an inevitable correction. Wait for that crash and buy the dip when the valuation returns to earth. Are you trying to get in on the pre allocation, or are you sitting this one completely? Drop your strategy in the comments below. Don't forget to hit that like button, subscribe for more institutional market breakdowns, and we will see you in the next video.